So first question is, under the UCC secure transaction article, when collateral is in secure parties possession, which of the following condition must be, sorry, it is related to attachment. We have not done that topic. So next question. Which of the following statement regarding a creditor's right against the surety is correct?
Option D.
The creditor must first attempt to collect debt from the primary debtor before being able to collect from the surety. No, creditor has equally the right that he can go for surety even before going to primary debtor.
Then option A.
Yes, correct. So surety is primary liable to the creditor. Okay, next is not related to this. Okay, under the secured transaction article of UCC, which of the following remedies is available to secured creditor when a debtor is failed to make a payment when due?
Option B.
Okay, so a creditor can proceed against the collateral and obtain a general judgment against the debtor. So both are correct. Correct answer will be B. Okay, next question. Which of the following event will release a non-compensated surety from liability? So when a surety, which of the following like is a defense for the surety that he can use to escape from the liability? Any guess? Which of the following will release a non-compensated surety from liability? So which of the following is basically a defense that a surety can use to escape from the liability?
Option A.
Any other guess? Any other guess?
Ma'am, option C.
Okay. So, first option state that filing of an involuntary petition in bankruptcy against the principal debtor. So, it can, if you are filing a involuntary petition, then it can be used to escape from liability. It is not correct because the principal debtor is bankrupt is basically not a defense that a surety can use that he will not pay. Okay. So basically, surety has the liability all in case the principal debtor default. Next is modification by principal debtor and creditor of their contract debt materially increases the surety risk of loss. So we already discussed this thing when we are using the remedies or defenses part. That if your principal debtor and creditor made some changes in their contract without informing the surety. Okay, so in this case, since the surety risk of loss is increases, in that case, surety can use this as a defense that the contract modification, he's not aware about this modification and therefore he do not have any liability to pay for the liability, to pay for obligation of a debtor. Okay. Next option state that release of principal debtor obligation by the creditor, but with the reservation of creditor rights against the surety. So if creditor is releasing the principal debtor obligation, so in that case, but the reservation of creditor's right against the surety. So that means if the creditor has the right to go for surety, then in that case, surety cannot use this as a defense. Insanity of principal debtor at the time the contract was in enter into with the creditor. So if your principal debtor is insanity means like do not have the proper capacity, so in that case your contract is void. Okay, so best answer in this case will be your option number 3. Is it clear?
Yes, ma'am.
Okay, then do this next question. Under the UCC Secure Transaction Article, if a debtor is default under a payment obligation secured by goods, the secured party has the right to. So if debtor default, then secured party has the right to peacefully repossess the good without judicial process, reduce the claim to the judgment, sell the goods and apply the proceed towards the debt.
Option D.
Okay, any other guess?
Ma'am, option A.
Okay. So if a debtor is default under a payment obligation which is secured by the goods, then in that case, the secured party means the creditor has the right to peacefully repossess the goods without judicial process so he can take his goods back, reduce the claim to a judgment. So he can also like reduce the claim to a judgment means he can have the goods repossessed and sold judicially and ask for his claim. He can also sell the goods and apply proceed towards the debt. So he has all the rights in this case. So correct answer will be A. Okay. Is it clear?
Yes.
Okay, next question. So this is under the secure transaction article of UCC in a situation where the financing statement contain no special provision and debtor has defaulted. The secure party has the right to. So again, you have to tell that which of the right of the creditor in this case. So which of the following is the right of creditor in this case? So should I explain?
Yes.
Okay. So this is also the same question that, but in this case there is no special provision and the debtor has defaulted. So what does the creditor has the right? So the to take peacefully take the possession of collateral without judicial process. So creditor can go for collateral without even without judicial process, but it should be peacefully, not something like you are threatening or you are doing some physical harm to the debtor. Or you can sell the collateral without notifying the debtor. So you are selling the property of debtor without even notifying them. Require the debtor to deliver the collateral to secured party. So the secured party has the right that the debtor deliver the collateral to the secured party or retain the collateral and proceed against the debtor for any balance due. So he can retain the collateral and uh, the creditor can retain the collateral and proceed against the debtor for any balance due. So he can take his collateral and uh, proceed he can use for any balance of the debtor. So what do you think? What should be the like more relevant answer in this case?
Option A.
Okay, any other guess? Okay, so the right answer is option number A. Okay, so every creditor has the right that he can peacefully take the possession of the collateral without judicial process, but he cannot sell the collateral without notifying the debtor. So you have to notify the debtor before you are selling their collateral. Next, there is no as such right that the debtor will comes to deliver the collateral. Okay, next, if he is retaining the collateral and the proceed against the debtor for any balance due. So if he is taking the collateral as well as like coming to the debtor for any balance that is due, this is not the right in all case, because if you are selling some goods to the debtor and he is not going to pay you, then you are taking your goods back, then there is no right that you can go after taking goods back, you can go to the debtor and ask for more payment. Okay, so correct answer will be A. Is it clear? Any doubt?
No.
Okay, security lien. Next question. Under the secure transaction article of UCC, a financing statement generally must, financing statement is also not done. Okay. Next question. The debtor may attempt to conceal or transfer property to prevent a creditor from satisfying a judgment. So we already discussed that sometimes debtor transfer their property to their near and dear so that it cannot be seized by the creditor. So which of the following action will be considered an indication of fraudulent conveyance? So which of the following is an indication of fraud? Which of the following these transfer will be a fraudulent activity?
Ma'am, last option.
Okay, any other guess?
Option D.
Okay. So first option state that debtor remaining in possession after the conveyance means has the possession even after the transfer of the collateral of or his property. So that means this is a fraudulent transfer. Next, secret conveyance means he is secretly transferring that property. Next option, the debtor retain an equitable benefit. So he is getting the benefit even after the transfer of property. So what do you think? All these cases will is an indication of fraudulent activity or not. All these indicate that debtor has willfully transferred this property so that it could not be seized by the creditor. So correct answer will be B or D. It will be D. So all of these will be correct. Okay. Okay, next question. Nash, Owen, and Paul are co-sureties. So these are multiple sureties with maximum liability of 40, 60, and 80,000. The amount of the loan on which they are agreed to act as co-surety is $180,000. So on this loan, they are acting as surety with these liabilities. So Nash has maximum liability of 40. He next is 60, and Paul has 80,000. The debtor defaulted at a time when the loan balance was 180,000. Nash paid the lender 36,000 in full settlement. Okay, so one of the surety has paid the amount in full settlement. The total amount that Nash may recover from the Owen and Polk. So, what do you think? How much amount he can cover from the other co-sureties? Will you able to do the calculation? So you can take their proportion. So out of 180, $40,000 of liability can be taken by Nash, means that his proportion will be $40,000 divided by $180,000. So you can take his proportion from this 36,000. Rest of the portion he can claim from other sureties. So please calculate and tell me the answer.
C28.
Okay, and Shravani?
I'm actually confused.
Okay. So we discussed about that if one of the surety has paid, like there are multiple sureties and one of the surety has paid the full amount, then he has the right that he can take reimbursement from other sureties. Okay. So here they do not have equal proportion. So it is given that their maximum liability can be this amount. Okay, from 180,000. $40,000 is the liability that Nash can pay. Next, Owen can pay up to 60,000, and then 80,000 can be paid by Poe. So here your loan is settled by $36,000, which is paid by Nash, and question is asking to you about the amount that Nash, means one of the surety who has paid this amount, can recover from other ones. Okay, so since this 36,000 will be divided among the co-sureties, so you can subtract the Nash contribution, and remaining contribution he can claim from the other sureties. Okay, so calculating his proportion, 40,000 will be divided by 180,000. Okay, then it will be multiplied by your 36,000 amount. So it will give you it will give you, I think, $12,000. Okay, so it is the proportion of this amount which comes in Nash account. So other amount, rest of the amount he can claim from the other co-sureties because he has paid it this
It is
amount.
$8,000.
8,000. Okay. So 36,000 was the amount he paid and 8,000 his proportion. Okay, so rest of the amount he can claim from other cost sureties. Is it clear? So suppose your friend has paid some rent on behalf of you. So now he can claim from you your proportion. Okay. Any doubt? Is it clear or any doubt?
Clear.
Okay, next question. Which of the following defenses would surety be able to assert successfully to limit the surety's liability to a creditor? So, which of the following defenses a surety would be able to assert successfully to limit the surety's liability? So, which defenses he can use to limit his liability?
Ma'am, option C.
Okay, any other guess?
Option C.
Yes, correct answer. Okay, so if the surety is a minor or a mentally incompetent person, he can use this defense to escape from liability. Okay, so first option stated a discharge in bankruptcy of principal debtor. So if the principal debtor becomes bankrupt, so it is obvious the main reason that creditor can go for the surety. So it is not the correct answer. Next, a personal defense the principal debtor has against the creditor. So if surety cannot use the principal debtor's defenses, okay, in order to escape from liability. Next option, the incapacity of principal debtor. So if your debtor is incompetent or some is a minor one, so in that case, your sure there is need for the surety, so your surety cannot use this as a defense. Next question. So it is also related to cost sureties reimbursement. Main bank linked LR 120,000 received securities valued at $30,000 as collateral. So at Main's request, Salim and Ray agreed to act as uncompensated co-surety on the loan. The agreement stated that the Salim's and Ray's maximum liability would be $120,000 each. So Main released Ray without Salim's consent. Eller later defaulted when the collateral held by Main was worthless and the loan balance was $90,000. So Salim's maximum liability here. So here basically your M is basically your creditor, E is debtor, your S and R means Salim and Ray are cost sureties. Okay, and their maximum liabilities are given. Next, your creditor has released one of the co-surety. Okay, and the Eller defaulted on the loan when the loan balance was 90,000. So in that case, your Salim's maximum liability would be so. So one more question after this. So your creditor has already released one of the core surety. Okay, so that means only one surety who is selling is left. So how much his liability would be in this case?
90,000 D.
Okay, so you think that he will pay $90,000. Okay, and what about Shravani?
Calculate.
Okay.
Or it will be option C, 45,000.
Okay.
Ma'am, C.
Okay. So since one of the surety is released by the creditor and only one is left, so his maximum liability is 120,000 out of 240,000. Okay, so 120 was the ratio. That means they are both are equally liable for the liability. So out of 90,000, if we divide it among the two, so each will get the liability of 45,000. So Salim is not released by the creditor, so he has the liability to pay this amount. But the other one is released by the creditor, so that means he do not have any liability. Okay, is it clear?
Yes.
Okay, next question. Which of the following act always result in total release of a compensated surety? So which of the following will result in total release of a compensated surety? So a surety will be totally free from paying any liability. Should I explain?
Ma'am, option B.
Okay. So let me explain. The principal debtor performance is standard. So principal debtor performance is standard means principal debtor has officially declared that he will going to pay. Okay, so he will fulfill his obligation. Second option state that the debtor obligation is partially released. So debtor is partially released from his obligation. So there is partial liability still pending. So if the debtor has not paid, then the creditor go for surety. Next, the creditor extend the debtor's time to pay. So if the time is extended, so that doesn't mean that the surety is released from the obligation. The creditor changes the manner of the principal debtor's payment. So if the payment manner is changed, so it also not means that the surety is release of the liability. So what do you think? Which will is the best answer in this case? So which is the answer in this case? So the correct answer will be A. Why A? Because that since debtor has officially declared that he is going to fulfill his obligation, so that means there is no obligation pending for the surety. So he is released from the obligation. Okay. But if the principal debtor obligation is partially released, so that means there is a partial amount which is still left to pay. So also if the time to pay or the change in payment method, so it does not release any of the debtor or surety from the obligation. Okay. Any doubt in this question?
No, ma'am.
Okay. So our next topic will be bankruptcy for tomorrow. So let just start. Then we will continue it tomorrow. Bankruptcy basically, what is bankruptcy? It is included in which of the chapters, and how is the bankruptcy is filed, and what are the various rights and obligations here. So first of all, what is the purpose of bankruptcy? So bankruptcy basically is a legal process whereby debtor is relieved from his liability and the debtor's creditor are given the satisfaction in the fairest way possible. So bankruptcy laws exist to provide debtor with the relief of overwhelming debt. So if someone is like overwhelming with his obligation, then he has the right that he can go to court and file for bankruptcy. And in this case, your creditors are given the fair treatment, means whatever the best possible they can have in that the case. Okay. The system seeks to balance a fresh start for the honest debtor and orderly and equitable distribution of asset to the creditor. So whatever the asset debtor has, debtor equally distributed among the creditors. So okay, so that a debtor can do a fresh start. Types of bankruptcy. So basically you have chapter 7, which is liquidation, chapter 11, which is reorganization, and chapter 13, this is adjustment of debt. So beside these, you also have some other chapters of bankruptcy like 9, 12, and 15. So chapter number 7 contains liquidation. So basically, trustees sell non-exempt asset to pay to the creditor. So what happened in chapter 7 liquidation? That all the assets of the debtors are turned over to the trustee, who basically sell these assets and try to satisfy the creditor claim. Okay, so this chapter number 7 is applicable for your individual partnership and your corporations. Chapter number 11 contains reorganization. Basically, business reorganization means debtor continue to operate the business while creditor meet the to restructure the debt. Okay, it is typically for the businesses where the debtor reorganizes operation and debt. Chapter number 13 contains adjustment of debt. So individual repay debt over 3 to 5 years. So basically debtor and trustee work out a plan to restructure the debt without the involvement of the creditors. So it is also applicable to the individual. Okay, individual which has like lower amount of debt to some there is certain limit. If they have debt lower than those limit, then they can go for chapter 13 bankruptcy. Okay, next is voluntary or involuntary bankruptcy. Means voluntary means like you are filing for bankruptcy voluntary as per your will. Okay, so debtor files a petition with the bankruptcy court. So without any pressure, without any uh, some without any coming under pressure, debtor has the right that he can go for voluntary bankruptcy. Involuntary means like when a creditor forces a debtor into chapter 7 or chapter 11 bankruptcy if certain criteria are met, means debtor not paying the debt as they come due. So creditor has the right that they can force the debtor to go for bankruptcy. Okay, any doubt? Next is automatic stay. So automatic stay is basically when a debtor go for bankruptcy, file the bankruptcy petition with the court, then the court gives us automatic stay, means a order of relief to the debtor, so that no creditor now can go for debtor and pressurize them for the their liabilities. So it basically hold all collection effort, lawsuit, foreclosure, and garnishment against the debtor. Okay, so automatic stay means it basically put a uh, stay so that no creditor can now go for the debtor because he has already filed a petition to the court. So it protect the debtor from harassment, prevent creditor from racing to seize the asset. Okay. Next, bankruptcy estate means when a debtor is filed the bankruptcy, then a bankruptcy estate is created. Basically, A trustee is hypothetical lien creditor that is created who which include all legal and equitable interest of debtor in property at the time of filing and certain property which acquired within 180 days like some inheritance, divorce settlement, life insurance proceed. So these come under bankruptcy estate. Okay, so bankruptcy estate means like all which contain all the asset property belonging to a debtor. Okay. Also, if certain properties acquired within 180 days of this bankruptcy, that is also included. And some of the properties excluded, which we will discuss later later in the slides. Next is a trustee overview. So trustee means a bankruptcy trustee administer the estate who can look for these processes. So his duty is basically to collect and liquidate the assets. So whatever the asset a debtor has, the a trustee collects those assets and liquidate them. Review financial affairs. So whatever the financial matters of the debtor. Object to improper claims. So if some creditor who do not have like proper rights uh, to get their claims, so this trustee will look for those improper claims. So ensure compliance with bankruptcy law. So whole the process should be done with the compliance with law. So he can look for those also. Is it clear?
Yes, ma'am.
Okay, so debtor, you already know that the person who basically has the obligation. So person or it may be business who basically owing money. Creditor to whom the money is of. So the person who has given the loan to the debtor. Discharge means release from personal liability on certain debt. Exempt property means the property which is exempted from with the property of debtor basically which is exempted from seizing. So property debtor may keep. So he can keep that property with him. Okay, it is exempted. Okay. Next example is John overwhelmed with credit card and medical debt file. Medical debt. So person who is overwhelmed with credit card liabilities and medical debt, so he can go for Chapter 7 bankruptcy. Upon filing, he will first get the automatic stay, which will stop all creditor calls. Trustee review his asset. Non-exempt assets are sold. So the asset which the trustee has the right that he can take the possession and sold them and give the money to the creditor. So those assets will be sold and the money is given to the creditors. Remaining eligible debt are discharged, giving him a financial start. Okay. So is it clear about bankruptcy?
Yes, ma'am.
Yes.
Okay. So next we will discuss about chapter 7, 11 and chapter number 13 bankruptcy. Okay, we will continue this topic tomorrow. If you have any doubt, you can ask. Any doubt?
No,
No,
nothing
ma'am.
at mine.
Okay, then we will continue tomorrow. Next topic.
Okay,
Okay.
ma'am.
Thank you.
Thank you,
Oh,
ma'am.
okay, bye.
Bye.